If you want to learn how to be a great investor, drive out to the closest farm, like maybe the one I grew up in Odin, Indiana, the middle of nowhere. There's one thing that farmers do that investors do not. If we could internalize this one thing, I think it would make us all much better investors. So in this video, we're going to talk about what farmers can teach us about investing.
This video is for educational purposes only. It should not be considered investment, legal, or tax advice. It is not an offer to buy or sell any security. Past performance does not indicate future results. Investing is risky.
So let's say we've got here a farmer, and we'll call him Farmer Johnson because, I guess that's what you call all farmers. So Farmer Johnson owns a bunch of land, and every year he produces crops on this land and sells it to the market. We'll say he grows corn. How much he gets for his crops has tended to increase over time. Last year, he earned $50,000 from his crops. Farmer Johnson mostly lives a peaceful existence, but he does have a pesky neighbor that comes over every single day, knocks on his door, and gives him an offer. The neighbor wants to buy all of Farmer Johnson's fields, and the price that he offers changes every day. So the neighbor came over and offered $1 million for all of Farmer Johnson's fields. So Farmer Johnson says, no thanks, and goes about his business. The next day, the neighbor comes over, and this time he offers him 10% less, so $900,000. We don't know exactly why. The neighbor happens to be manic depressive, and sometimes he's in a bad mood, sometimes he's in a good mood, but today he's in a little bit of a worse mood than yesterday. The very next day, he comes back with an even more shocking offer. He's in a terrible mood, completely depressed, and today he offers half of what he did a couple days ago, $500,000. What do you think Farmer Johnson is going to do? Does he feel like he's lost $500,000 compared with a couple days ago? I don't think so. Farmer Johnson isn't paying attention to the dollar amount that his neighbor offers him. He doesn't feel like he's somehow lost money on a day-to-day basis. And the reason is that Farmer Johnson is not thinking about the market value of the land. He's thinking about the crops that he can generate from the land that he owns. And as long as the crops tend to increase in value over time and continue to generate the kind of income he needs to live, he's not too concerned about the value of the land. Now, there may be a certain case where the land deteriorates, maybe the quality of it declines, and he's not able to generate as much crops with that particular acre or parcel, whatever you call it. So then maybe he decides he wants to sell it or something like that. But for the most part, he's interested in the crops that the land will generate. Now, let's consider how investors tend to respond. So if you see your portfolio go from $1 million to $900,000 in market value, most people get a little upset about that. If you see it go from $1 million to $500,000, that is catastrophic. People will panic and sell their stocks to the neighbor just because someone else thinks those are worth less than they were a couple months ago. All most investors think about is the fluctuating market value of their portfolio. There's nothing tangible for them to grab a hold of and continue to hold their stocks even when the market value is plummeting. If there's one thing investors could learn from the farmer, it's to think about your stocks in terms of actual tangible assets, which they are. You own real-life businesses that are hopefully making actual money, and even better, returning some of that money to you in the form of both dividends and stock buybacks. If you own a business that's generating real cash flow and returning that cash flow to you, you in effect have farmland that's generating crops in the forms of profit. Now, sometimes the market value of the land is going to fall, right? Sometimes the stock market's going to go down 20%, sometimes it's going to go up 20%, down 50, up 50. It's going to fluctuate on a daily basis, but as long as you are focused on the market value alone, you're going to have a really difficult time sticking with it over the long term, which means you're going to get worse returns and you're going to have ulcers probably from paying so much attention to what everyone else thinks your portfolio is worth. Instead of doing that, you need to focus on the actual tangible real life money these businesses are generating on your behalf. So when your neighbor comes to you and says, hey, I'm going to offer you, half of what I offered you a couple months ago for your stocks, ask yourself the question, what would a farmer do in this scenario? Would he or she be all worried because the value of their land has declined a little bit? Or would they be focused on the crops? And I think the answer to that is almost always they're focused on the crops. So with your investment portfolio, pay attention to what the fundamental cash flows, dividends, buybacks from that business are. If those continue to be strong and you expect they will continue to increase over time, there's no reason to panic and sell your stocks just because the market's down a little bit. Thank you so much for all of you that are currently supporting the channel. I really appreciate it. If you want to support the channel, you can click the join button down below. So how do you decide whether the land is good or there's better opportunities elsewhere? We'll explore more of those in the next video. Thanks as always for watching, and I will see you in the next video.